Welcome back to Designing Effective Commercial Insurance Programs. This is a multi-part series of videos talking about just what are the best ways or some of the concepts that agents and underwriters should use when they are designing commercial insurance programs. In part two, we talked about some of the considerations people should make in deciding what to insure. In this short video, we're going to be talking about some concepts about making sure that dollars are well spent. So welcome back. Welcome back to Designing Effective Commercial Insurance Programs. In this video, we're going to be talking about where are insurance dollars best spent. My name is Rick Faber, co-founder of Underwriter's Resource. Since insurance is purely an expense, there is no return on it, unless you consider recovery from a loss return on investment, which it is not. Therefore, to create the best cost-effective structure, insurance dollars must be spent where they provide the most necessary protection. For example, let us take a quick look at property deductibles. Higher deductibles do generate premium savings, but the discounts never seem large enough to justify selecting the larger deductible. This is a frequent and strenuous argument against an insured purchasing a higher deductible. However, it is an argument based upon a common misunderstanding and incorrect view of the facts. Here's a simple question that's often asked. Why should an insured increase their deductible from $500 to $5,000 for a paltry savings? It's a relatively simple question, and that answer appears to be simple. They should not. However, that argument is simply wrong. The correct answer should be that layer of insurance is extremely expensive and does not need to be insured anyway. The truth is incremental or marginal rates for lower deductibles are extremely high. For example, let's assume that an insured can save $450 to increase their deductible from $500 to $5,000. On the surface, it does not seem like a good deal. However, if you consider that for $450, they're only buying $4,500 worth of insurance. For $450 for a $4,500 limit computes to a $10 per 100 rate. Considering that a well-protected risk would usually have a final property insurance rate below 10 cents per $100 of insurance, my question now becomes, what reason would an insured have for paying 100 times higher for insurance that they do not need to buy? Also, losses do not usually occur every year, so the truth is savings compound every year that the insured does not have a loss. In addition, smaller businesses get a higher percentage discount than larger property risks, but large insureds get a larger premium discount. To illustrate, consider two different risks located in the same building. Assume they are both clothing retailers. The first is a small boutique with only $250,000 in stock. The second is a large retailer with $5 million in stock. Assuming the combined property rate is 20 cents per 100 of value with a $500 deductible, and there is a 50% split between the fire portion of the total rate, Group 1, and other causes of loss, Group 2 and Group 3. Both insureds want to consider a $5,000 deductible. Based on ISO rating, the first account, the boutique, would receive a 21% credit on the Group 1 rates and a 41% credit on the rest of the property premium. They would receive a $155 credit, which represents an overall rate credit of 31%. The large clothing retailer would receive a 5% rate credit on the Group 1 rates and a 16% credit on the balance of their premium. Their premium would drop from $10,000 to $8,950, which represents a 10.5% premium credit and a premium savings of $1,050. Remember that both risks had a 20-cent property rate. The margin of rate savings are significantly higher than their property insurance rate. Therefore, by increasing their deductible to $5,000, they lower their net property rates to 0.141 and 0.18, respectively. The question we should be asking is where and how are the insured's insurance dollars best spent? Where are they getting the best value? One goal of any insurance program should be cost effectiveness. Are the insurance dollars spent on coverage needed and not on coverage for losses the insured cannot finance through other more cost-effective means? As underwriters and agents, it is our duty to serve as our client's primary risk management consultant, particularly for small and medium-sized businesses who may be less savvy insurance buyers. That brings us to the end of this video. In the next video in this series, we will talk about avoiding duplicate coverage. If you found this video helpful, please be sure to like it and subscribe to future videos. If you have any questions about the subject matter in this video, please leave them in the comments section below or email us at richard.uwresource@cox.net. Remember to like this video and subscribe to our channel.